So how do you check out a financial professional? So we tell people how to check out a financial professional. Do you ask for references? No. Won't help you one bit. How long they've been in business? No, I won't help you out either. Some of the best advisors are new young advisors. How about their fancy title? That's the thing about the financial industry, they don't have titles regulated. So they can call themselves anything they want to make themselves look good. How about their credentials? Maybe. There's credentials out there though that you could give the company $1,000 and spend 2 weeks and they'll give you a credential. There's others like certified financial analyst or a certified financial planner like I am, takes you years to get. And of course the organization, you can go there and actually check out the credentials. And they have the disciplinary history and all that stuff too. Now some of those victims that I showed you at the beginning in those folders, some of those were CFPs though. So a CFP doesn't make you honest, but it's more likely that you're going to get a good financial professional. So that's a maybe. Trust me, I am a professional.
Let me talk to you about retirement. 401k is the most sound way to go. Let's talk asset allocation.
Sure.
You seem knowledgeable, professional.
Would you trust me as your financial advisor?
I would.
I would indeed.
Well, let's be clear here. I'm actually a DJ.
No way.
I have no financial experience at all.
That really is you.
If they're not a CFP pro, you just don't know. Find a certified financial planner professional who's thoroughly vetted at letsmakeaplan.org. CFP, work with the highest standard.
You have to check out the credentials. So this is from the North American Securities Administrators Association. They send out the red flags of fraud every year, so I check them out. But here's just one of them. Are you potential scam bait? Here's the pitch. You can trust me. I have credentials and extensive experience. And then the client or the investor believes it, and that's that. They leave it at that. So here's the catch. The truth is that credibility can be stretched and faked. If the promoter is legitimate, he or she should have no qualms about your conducting a background check. Take the time to determine if the authenticity of the individual's education and experience requirements by contacting the organization that issued the credential. Most importantly, contact your state or provincial securities regulator to determine if the person is registered to sell investments and does not have disciplinary history. A lot of those people in those folders, the people already had disciplinary history. I've checked out other financial professionals for clients that had disciplinary history. I said, why do you even give a dime to these people? Crazy. So do you check the record with the regulatory agencies? Yes, absolutely. Protect your money. Check out brokers and investment advisors. Federal or state securities laws require brokers, investment advisors, and their firms to be licensed and registered to make important information public. But it's up to you. It's up to you, the investor. It's up to the investor to find that out and to use it to protect your investment dollars. The good news is that this information is easy to get, and one phone call or web search may save you from sending your money to a con artist, an unscrupulous financial professional, or a disreputable firm. So we put this on our website. We put the links on there. This is FINRA. This is the regulatory body that regulates brokers and broker-dealers. And it brings you to this website, and you can check out the individual or the firm. And then this one is for investment advisors. Investment advisors have their other website that's regulated by the SEC. You go to their website and it brings you to this, and then again you can check out the individual or the firm if there's any issues with them. So how do you check out a financial professional? Ask, will they state in writing? Will they state, are they a fiduciary in writing? Will you act in my best interest at all times with all financial products? You guys have probably seen this in some of our materials and some of our emails that we send out and in our newsletters. This is our fiduciary commitment to you guys. Royal American Financial Advisors is a fiduciary advisor. In keeping your best interests in mind, we will not accept any commissions, fees, or incentives from any third parties or financial institutions. We have made a commitment to only accept compensation directly from our clients. By making this commitment to not accept compensation from third parties, we eliminate various potential conflicts so you can have additional confidence that we are making decisions in your best interests. The product does not drive our decision-making for you guys. Ask, does the firm you work for have production requirements? A lot of these broker-dealers and a lot of these insurance agencies, they are after their representatives to produce and generate commissions. So they want transactions over as many as they can. Ask, do you receive higher fees, commissions, and incentives and bonus money for selling certain financial products? Bonuses are rampant in that part of the industry. Ask, is your obligation to the firm or is it to me? Ask, do I pay you directly or does your firm pay you for product sales? These are all important questions to ask. Here's a great example of that. Brokers pushing Puerto Rico bonds.
Folks, in recent years, thousands of Puerto Rico residents lost their life savings. Many blame UBS, whose brokers sold them funds that were over-concentrated with Puerto Rico bonds that blew up as the island's economy crumbled. A CNBC investigation found that within UBS, some brokers raised red flags early on. Leslie Pickard joins us right now with part of her story, Broken Bonds.
Hey, Becky, that's right. We reviewed thousands of confidential documents, including internal emails, showing that employees at UBS were worried about the risks from selling bond funds to clients in Puerto Rico. But instead of fixing the problems, brokers were pushed to continue selling the funds.
So they were pushed to continue selling the bonds. So most of these insurance agents and the brokers, they are really nice. Most of them are well-intentioned. You know, they're thinking about the client, but they're paid for selling products and their duty is to the firm. So if they were paid by their clients, do you think they would have continued to sell those bonds? They would have stopped in. There's no way I'm going to sell that junk to my clients. My clients are paying me. But the firm is paying them to sell those products, so they continue to push them to sell them. And of course, they blew up. Here's another perfectly legal deception. The stuff I'm showing you here today, the vast majority of the investment public has no clue. Because we meet people that have brokers and insurance agents and all this thing, and they have no idea that this stuff is going on behind the scenes. Registered representatives, which are more commonly called brokers, can wear two hats. These large brokerage houses, they have their broker-dealers, and then they create these registered investment advisory subsidiaries. Then they allow the brokers to put a little bit of money or some money with the registered investment advisor, and it allows them to call themselves fiduciaries, even though they're working for the firm and part-time fiduciary. So when you're sitting across the table from a duly registered person, are you sitting with the fiduciary or are you sitting with the commission salesman? You have no idea. Have no idea. It's perfectly legal and it should be outlawed. Should never be able to happen. Ask, does the firm you work for receive money or from other companies for selling their products, commonly called revenue sharing? Okay, here's a typical revenue sharing disclosure buried deep into their materials from Edward Jones, but they all have them. You know, Goldman Sachs, Morgan Stanley, you know, all the big ones, Investacorp, you name it, they all have these revenue sharing disclosures. Edward Jones receives payments known as revenue sharing from certain mutual fund companies, 529 program managers, and insurance companies, collectively referred to as product partners. Okay? Virtually all of Edward Jones' transactions related to mutual funds, 529 plans, and annuity products involved product partners that pay revenue sharing to Edward Jones. And then they put this little line in here to kind of give them a little way out. We do not receive revenue sharing payments from assets within investment advisory programs. So remember that little subsidiary that they set up? They can't take revenue sharing for that, but all this stuff over here, which is the majority of their business, they can. So, of course they can. It's illegal. You can't. but they're duly registered. We want you to understand that Edward Jones' receipt of revenue sharing payments creates a potential conflict of interest. You think? Yeah. A potential conflict of interest in the form of additional financial incentive and financial benefit to the firm, its financial advisors, and equity owners in connection with the sale of products from these product partners. So it's not just the commission plus the revenue sharing. For the year ended December 31st, 2017, Edward Jones received revenue sharing payments of approximately $181 million from mutual fund and 529 product partners and $5.6 million from annuity product partners. For that same period, Edward Jones' net income was $871 million. So if we do a little quick math, that's what, a little over 20% of their revenue is from revenue sharing? Most, but not all, of the product partners that pay revenue sharing to Edward Jones have been designated as preferred partners. So what do they put you on the top shelf, right? Additionally, while Edward Jones and its financial advisors may sell, and our clients are free to select, funds from many mutual fund families, we predominantly promote mutual fund preferred product partners, buried deep in their disclosures. So here's what you get if you go to Edward Jones, most likely. American funds, BlackRock, Federated, Franklin, Goldman Sachs, Hartford, Invesco, Ivy Funds, John Hancock, JP Morgan, Lord Abbett, MFS, Oppenheimer, and Putnam Group. Hundreds of millions of dollars paid to them. And you guys probably don't recognize these names because you guys don't have any of these in your portfolios. These are all, not through us. You did though, yeah, you did. But these are all available to us through TD Ameritrade. We could use these if we wanted to. It's almost worse in the insurance industry. Here's some recent ads, soliciting insurance agents. So I'm going to show you some inside stuff, right? So here's some hidden incentives. They're offering $500 for each application that you write in March with March Madness. So let's use a hypothetical example. This is through Equitrust. So let's say there's an annuity paying 4.5%, and Equitrust is hypothetically, paying 4.25%, but the agent gets the extra $500 if he writes it through Equitrust. The client is none the wiser, wouldn't have a clue that this is going on. Doesn't have to disclose it. Registered investment advisors, we have to disclose all fees, commissions, and all that kind of stuff, so you guys know exactly what you're paying for it to us. Plus, if we did accept third-party stuff, which we don't, we'd have to disclose that too. So if we got a bonus from somewhere, Scott and I would have to tell you. Here's another one. Incentive reward conference, 4 nights at a luxury resort during the qualification period. Vacation in Los Cabos for only $750,000 in fixed annuity production. Take an all-inclusive trip to Los Cabos, Mexico. So you're right on the bubble to get that trip, right? But that annuity pays a little bit lower interest rate to the client. You get that trip to Mexico. It's crazy. 11% annuity commission. That is absolutely crazy. And I guarantee you, this annuity commission, the interest rates are going to be lower because the insurance companies have to get the money from somewhere. If they give that out to the insurance agent, they get it back from the client. They're going to make the same profit. So the insurance agent has the choice. They can sell a fair commission on an annuity like this, and maybe 5%. You get a decent interest rate at 5% commission. But now the client wants to deposit $200,000, which is good, a typical annuity. $200,000 is not a large annuity. $22,000, $10,000. Absolutely crazy.